Welcome back to Wealth Wednesday. I'm Neil Watson, and joining me today is my colleague and fellow CFP professional, Vince McManus. Today, we're tackling a really important topic, charitable giving. Not only is it a great way to support causes that matter to you, but with some planning, it can also be a very smart strategy. We'll talk about that next. Vince, not too long ago, taxpayers who didn't itemize were able to deduct a small cash contribution to charities. That provision was phased out, which meant that for many people, there weren't really any tax benefits for making those ongoing contributions.
Correct, Neil. That's set to change in 2026. Married taxpayers will once again be able to deduct up to $2,000 per year for cash contributions, and single taxpayers up to $1,000, even if they do not itemize.
And here's why this matters. The standard deduction is now so large that over 90% of Americans no longer are able to itemize their deductions. That means for most households, there's been no tax benefit at all for those charitable contributions.
Yep. And again, the new provision, so it provides a modest incentive, at least, to encourage generosity, which has long been a goal of the tax code, with a little tax break attached. So as 2026 approaches, make sure you're keeping good records of the donations that you do make to the various charities that you prefer.
Yeah, and that brings us to one of my favorite strategies, and honestly, one of the best tax planning tools available for seniors. That's the qualified charitable distribution, or QCD.
Yep, definitionally, a qualified charitable distribution is when a person directs their IRA custodian to send money straight to a charity from the account. And by doing that, you get a pretty nice tax break.
Yeah, the tax break isn't obvious because it's not really a deduction. Instead, the amount you send to the charity is simply not reported as income. It does have the same effect as a deduction.
And fortunately for us, and I think because it's ended up being fairly popular because of its utility, some of the custodians are starting to make the process a little bit easier to track. In fact, many are now reporting qualified charitable distributions directly, whereas in the past, it was completely up to the taxpayer to keep track of that.
Yeah, and this is a fantastic strategy because it can help you satisfy your required minimum distribution. And for those who don't actually need their distributions to cover living expenses, it can reduce the tax bill.
Simple example I like to use is church giving. So let's say that you put $20 in the collection basket each Sunday. Instead of doing that, you could send $1,000 from your IRA directly to the church. So you're giving the same amount you planned on giving throughout the year, but now you also get that tax benefit.
Of course, there are some rules here that you have to be aware of. You have to be at least 70 and a half years old. And the maximum you can give away this way in one given year is right around $100,000.
Additionally, since the funds are going to a third party, most custodians will ask you to complete a form. So if you're considering this, don't wait until the last week of December, because again, like at certain times they have a lot of paperwork, and maybe what they usually could get done throughout most of the year in a week or 2 weeks, it may even get pushed out to a month. So it's best to start the paperwork early. You know, my suggestion probably is that's something that you maybe start looking at end of Q3, beginning of Q4.
So let's shift our focus for a moment to those who actually itemize those deductions. And with the new limits on state and local income tax provisions in the itemized deductions, this might actually apply to a larger number of taxpayers than before.
That's correct. The tax law currently allows charitable donations to be deducted up to 60% of a taxpayer's adjusted gross income, and that's considered permanent, which permanent has a different definition in Washington, D.C. and Congress than it does for most places, but we'll leave that one alone.
Right. And there's a detail many people miss. Those deductions are also subject to a floor, which is somewhat new. Only the charitable contributions that you make that exceed 0.5% of your adjusted gross income are deductible.
Here's a simple explanation of this. If your adjusted gross income is $100,000 and you make a $1,000 charitable donation, so 500 of that would count as a deductible amount because of that floor.
And there's one more wrinkle. For high earners, the value of that deduction can actually be limited. The benefit is there, but not for those at the highest tax brackets. That benefit is going to be slightly reduced. So let's shift focus for a moment to a strategy that doesn't always come to mind, and that's donating appreciated securities, things like stocks or mutual fund shares.
Sure. So over time, anytime we make an investment, we kind of have a similar goal. We want that investment to grow in value. If not, we would spend that money for current consumption. So that's the natural trade-off that you're thinking about when you decide to make an investment. So in some cases, and hopefully the cases for any of our clients who decide to work with us for a long period of time, those gains can be pretty significant.
And what a lot of people don't realize is that you can donate those appreciated shares directly to a charity, and that makes this a really interesting strategy.
All right, another quick example here. Let's say that you own 100 shares of a company that is now worth $200 each, so $20,000 in total. And you originally bought those for $10 a share.
And that means you have a gain of $190 per share, or $19,000 in total. If you sold those shares, you'd owe capital gains taxes on that $19,000.
In the alternative, if you are charitably inclined and you were going to make charitable gifts of that amount, a smart strategy could be to donate the stock directly instead of selling it, because as a taxpayer, you would get a charitable deduction for the full $20,000 value, and you would completely avoid paying capital gains tax on that growth.
Yeah, and this can be a powerful strategy, especially when a charity is running a capital campaign or raising funds for a larger than usual project.
Correct. And of course, as always, there are some logistical details, paperwork, transfer timing, working with your brokerage and the charity. So it is important to coordinate all those things carefully to make sure that it's done the right way and it's done in a timely manner. Again, best practices for me is at least starting at the beginning of that last quarter of the year or the end of the third quarter, just to make sure that you're giving yourself plenty of runway for the normal things that happen that may come up. That's kind of some sand or bumps in the road that you'll hit, so that you can still get that in a timely manner.
Exactly. And now we've covered a lot today, Vance, but the bottom line is this: it's easier than ever to support the organizations you care about and get some benefit from it.
Yep. So there are some meaningful tax incentives to do it. Again, if you're charitably inclined and you get a tax incentive, that's what I always call a win-win. So reducing the government share of your money while helping a good cause, that's even more of a win-win. Because again, more goes to the charity, and I'm not against paying taxes and supporting our government. There are things that they do that are useful, but for most people that I talk to, if there's a way that we don't have to give too much of our hard-earned money to the government, like, we're usually open to that.
Absolutely. If you'd like to explore the overall impact of how a giving strategy can fit into your financial plan, we'd be glad to walk you through that.
And if you need help coordinating your giving, whether it's cash, stock, or IRA distributions, we're here to help guide you.
And thanks for joining us today. If you found this information helpful, do us a favor, hit that like button and please subscribe so you don't miss another episode of Wealth Wednesday. Thanks for watching. See you again soon.